There's a number of layers of how inflation can occur, but the one key piece that's different this time has been the reaction of governments. So governments are specifically so the money supply has expanded. Now the money supply expanded in 2008, 2009, not to the extent it is now. So the first thing we should recognise is this is much greater expansion of money supply than we've really seen outside of a wartime. So it's been quite extreme. But it happened in 2008, 2009, didn't really create inflation. Why would it be different this time? The real key difference is the mechanisms that are being used. Governments are putting money straight into people's pockets. So rather than bypassing it by making rates really low so banks will lend and giving banks money to lend out, or finding ways of trying to get that money supply into people's pockets indirectly, they're bypassing all that this time and just giving it straight to you. So it's going straight in your pocket through JobKeeper, straight in your pocket through JobSeeker. So by bypassing all those mechanisms, you're not relying on them to get the money supply moving. You're actually just cutting out the middleman and giving it straight to the person who might spend it. So that's the first thing that's really different this time. There is now available money to spend. Now the big question mark becomes, okay, fine, there's money to spend, but why would I spend it? And that is the debate. I think it's a valid debate to be having. But one of the differences that the pandemic has thrown up is you're also now, for the first time in a long time, getting supply constraints. So you address the demand side through governments putting money straight into people's pockets. The other bit that's hard to understand, but it's there as a factor we need to be cognizant of, is there's supply side constraints. So what's a good example of that? One of the project hosts on the project was having to get his daughter from Canberra to Adelaide to see her grandmother. Hadn't seen her grandmother. So they're about to change the border rules, need to get the daughter from Canberra to Adelaide by plane. He said, okay, I'll go and pay for that. It was going to be $550 one way. Why? Because there's supply constraints around how many seats the airline can fill. Now that may change quite quickly, but supply constraints are globally popping their head up for the first time in a very long time. Now, as an investment industry, we're sitting back thinking, well, this might be transient. We get a vaccine, this all disappears. I'm not necessarily sure that's the case. And the reason the supply side stuff is showing up more in our scenarios is we can see that certain companies will redirect their supply chains. There will be constraints and bottlenecks across a number of industries. There will be different ways people behave going forward around globalisation, around crossing borders, around sharing information, all those types of things. So we've got the demand side issue being addressed by governments and the supply side potential constraints kicking in that could generate inflation really quickly. Now, we don't know if that's going to happen. This is part of the whole investment futures framework. We're not saying there's going to be inflation, but we can paint a really credible case how it can appear, but also within our scenarios, we're seeing those type of inflationary constraints show up. There's a couple of ways we can think about this. One is, what is the market pricing? So the one that the market tends to use as a nice bellwether of expected inflation is called the break-even. So the difference between nominal bond rates and real bond rates. So you can see it in the US at the moment, it's around sort of 107 or 1.7%. So expected 10-year inflation in the US is around about 1.7%. So we can point straight to market indicators for expected inflation. But better indicators of expected inflation, I think, are just looking at the way companies are behaving. Are they using their pricing power? So we'll see the market move to price in certain levels of inflation, but the rubber really hits the road when you start to see companies use their pricing power. The example of the airline being able to charge $550 for a one-way ticket to Adelaide. You see it coming, you see it in restaurants. You'll see it, there's a number of different areas where you're starting to see those supply constraints at the specific company level, meaning that they start to use their pricing power. If that starts to play out more broadly, that's a really keen indicator for us that we need to be concerned about inflation.